Welcome to the deep dive. We're here to take those really dense corporate documents, quarterly reports, investor slides, and pull out what you actually need to know.
Yeah, cut through the noise.
Exactly. Today, we're tackling Honeywell International Inc. It's not just about the numbers. There's a massive corporate transformation happening right now, and we're going to decode it.
Right, that's the big theme in these Q3 2025 results. It's more than just a quarterly update. It really reflects a fundamental strategic pivot.
A pivot towards what, exactly?
Management's really reshaping the whole company. They're aligning everything around, let's say, three huge long-term trends. Automation, the future of aviation, and the energy transition.
Okay.
So we'll walk you through the new structure they're building and, how that's hitting the financials we saw this quarter.
Okay, let's jump right into that structure then, because it sounds like the old Honeywell is, well, disappearing.
In a way, yes. They're actively changing things, shedding some legacy businesses, carving out new, really focused segments. It's all about targeting these high-growth automation markets.
So what's the core change?
It's this strategic realignment they announced back in October 2025. It's set to kick in officially first quarter of 2026.
Okay, early next year.
Right. The whole idea is to go from this very broad, diversified company to four pretty distinct reporting segments,
Wow.
much more focused.
And those four are?
You'll have Aerospace Technologies, that's a big one, then Building Automation, and then two newly defined segments, Process Automation and Technology, they're calling it PA&T,
PA&T, okay.
and Industrial Automation, or IA.
Right, so aerospace, building automation, PA&T, and IA.
Got it. But you said PA&T and IA are newly defined. How are they being formed? Sounds complicated.
It involves some internal shuffling, yeah. It's probably the most technical part of this whole realignment. They're basically stitching together pieces from the old structure.
Okay, break that down for us. PA&T first.
Okay, so the new Process Automation and Technology, or PA&T, is being made by taking their UOP business.
Which used to be in Energy and Sustainability Solutions, right? Exactly. Taking UOP and merging it with the main part of Process Solutions, which used to sit within the old Industrial Automation segment.
So UOP, think refining, petrochemicals, catalysts, combining with process solutions. Is the goal here to create like a pure play segment for those heavy, complex process industries, like industrial chemistry automation?
Precisely. That's the strategic logic. Combine these specialized units, and you get this focused engine aimed right at industrial chemistry, complex processes, and, importantly, the energy transition.
Interesting. Okay, so if that's PA&T, what's left for the other new segment, industrial automation, IA?
So IA keeps the parts that are more focused on, let's say, high-volume industrial applications and logistics. Think smart energy systems, thermal solutions, process measurement and control.
Standard industrial stuff.
Right. And crucially, IA also holds on to sensing and safety technologies. And, for now at least, the warehouse and workflow solutions, WWS, and productivity solutions and services, PSS businesses.
Ugh, WWS and PSS. So if PA&T is the heavy industry focus, IA sounds like it's geared towards, warehouses, supply chains, e-commerce, logistics. That's a huge growth area itself.
It absolutely is, and that's the point, right? Unburdening each segment to really zero in on its specific megatrend.
Makes sense.
And speaking of unburdening, we really need to talk about the pace of the spin-offs and divestitures. They've been busy.
Relentless seems like the word. The Solstice Advanced Materials spinoff that's happening like literally as we speak, right?
Yeah.
Effective October 30th.
Yeah, end of this month. That basically completes their exit from the advanced materials business. It's becoming its own separate company.
And for anyone listening who holds Honeywell stock, what's the deal there?
Good question. The mechanics are important. If you're an eligible shareholder, you'll get 1 share of the new Solstice company for every 4 shares of Honeywell stock you held as of the record date, which was October 17th, 2025.
Okay, so 4 shares gets you 1 Solstice share. Automatic distribution.
Exactly. But that's Solstice, happening now. Then there's the other huge separation they've announced, aerospace. That's planned for later, second half of 2026.
Why the big gap? Spin Solstice immediately, but keep aerospace for another year or so. What's the thinking there?
That's a great strategic point. It suggests they're timing each move carefully. Maybe market conditions, maybe internal readiness. Solstice is ready to go, helps clarify the portfolio now.
Okay.
Aerospace is it's massive, much more complex, needs more time for internal setup, regulatory stuff, getting the valuation right in the market. They probably don't want to rush the biggest piece.
Makes sense. And it wasn't just spins, right? They sold off the PPE business too.
They did. Personal protective equipment. That sale closed back in May 2025. Brought in a nice chunk of cash, over $1.1 billion net.
Wow.
And remember those PSS and WWS units we mentioned in the new industrial automation segment?
Yeah, the warehouse and productivity ones.
Right. They're still evaluating strategic alternatives for those,
Yeah.
which is often corporate speak for might sell or spin these later, too.
So the message is really clear. If it's not core to these big themes, automation, energy transition, future of aviation, it's probably out or on its way out.
That seems to be the strategy.
Yeah.
But it's not just about subtracting. They're also adding pieces through acquisitions. Selectively, though.
Right. Targeted additions, spending big where it counts.
Exactly. Focused on what they call high ROI, outcomes-based solutions. Like in the building automation, they dropped nearly $5 billion, $4.9 billion on excess solutions back in June 2024.
Or $4.9 billion.
And for aerospace,
Yeah.
likely prepping it for that future separation, they bought CAES Systems and Civitavi Systems in August 2024. Those focus on critical tech like radio frequency systems and navigation tech, bolstering the core.
Okay. One more piece before we hit the quarterly number, something kind of hiding in the corporate and all other segment. Continuum.
Ah, yes. Quantinuum, their quantum computing venture.
The numbers associated with this are just wild.
They really are. It's a majority-owned investment, but look at this. A $10 billion pre-money valuation they're citing. Raised over $600 million in capital.
$10 billion valuation.
And the brainpower, over 375 people with PhDs or master's degrees working on quantum hardware, quantum chemistry platforms.
Wow.
It's definitely their big long-term bet on foundational tech, way beyond the usual industrial cycles. It shows where some serious R&D money is going.
Okay, so that's the massive restructuring backdrop. Now, how did the actual businesses, the ones sticking around, perform in Q3? Quarter ending September 30th. Overall sales looked decent.
Yeah, pretty healthy. Net sales overall were up 7%, hitting $10.4 billion. That came from about 3% more volume and 3% from price increases. Pretty balanced.
But you mentioned noise earlier, acquisitions, divestitures. What's the organic growth picture? That strips all that out, right?
Exactly. Organic growth is key here. It shows the real underlying momentum of the portfolio they're trying to build. And the picture varies quite a bit by segment.
Okay, let's go through them. Who was the star performer?
No question. Aerospace Technologies.
Yeah.
Just exceptional momentum. They posted 12% organic growth. 12%.
Wow, that's huge for a business that size. What drove that?
Mostly volume. Really strong demand in commercial aviation aftermarket. You know, more flights, aging planes needing maintenance and parts. Plus, solid results in defense and space, too. That segment is clearly firing on all cylinders ahead of its spinoff.
Okay, 12% for Aero. What about the automation segments? Building automation.
Building automation had a very solid quarter. 7% organic growth.
Still strong.
Yeah, definitely solid. Confirms the strategy there, it seems like. Good demand for both their physical products and their digital building management solutions. This segment's consistency is worth watching. It's a big long-term focus for them.
All right. Now, the tricky one, industrial automation. The segment kind of in the middle of this identity shift.
Yeah, tricky is a good word. Industrial automation showed pretty slow organic growth, just 1%.
Only 1%.
Only 1%. And if you look at the reported sales, they were actually down 9% compared to last year.
Why the big difference?
That's mainly the impact of selling the PPE business. That revenue's just gone now. So the 1% organic number suggests the remaining core parts are, well, maybe a bit distracted by the restructuring, or resources are being shifted as they figure out what to do with PSS and WWS. It's clearly a segment in transition.
Okay. And last one, energy and sustainability solutions, which is about to lose the Solstice business.
Right. For Q3, organic sales there actually dipped slightly, down 2%.
Any reason why?
They specifically called out lower sales volumes for refining catalysts within the UOP business. Seemed like maybe a temporary blip, but it shows some volatility in that specific market.
Well, wait, the total sales for that segment were up?
Yeah, total sales were actually up 11% year over year. That's purely down to acquisitions they made, like Sundyne and LNG Process Technology.
Okay, so acquisitions masked the slight organic dip, reinforces that strategy of buying into key areas.
Exactly, buying growth and capability.
All right, now for my favorite part, the footnotes. This is where things get interesting. You find these one-off items that can totally skew the bottom line, right? And Q3 seems like a prime example.
Oh, absolutely. The reported net income for Q3 was definitely on a wild ride. There were two massive, non-recurring financial events that hit the books this quarter. You absolutely have to understand these to make sense of the reported profit.
Okay, lay them out for us. Let's start with the big positive surprise. Something about an old agreement.
That's the Resideo gain. Remember Honeywell spun off Resideo years ago?
Vaguely. Yeah, home products, right?
Right. Well, there was this lingering indemnification and reimbursement agreement between them. Honeywell just terminated that agreement in Q3. And as part of that termination, Resideo made a huge one-time cash payment to Honeywell.
How much?
$1,590 million. So nearly $1.6 billion in cash just landed in their account.
Wow, $1.6 billion. So that obviously flows through the income statement as a massive gain.
It sure does. It resulted in a pre-tax gain of $802 million being recorded right there in the Q3 results.
$802 million gain.
Huge boost to the reported numbers, but completely unrelated to selling turbines or software this quarter, purely cleaning up a legacy deal.
Got it. A massive one-off gain. But then on the other side of the ledger, there was a big cost related to cleaning up something else.
Exactly. Offsetting that gain, strategically speaking, was the asbestos liability divestiture. Management made a big move here. They decided to permanently divest, basically get rid of their legacy Bendix asbestos liabilities and some other non-Bendix ones too.
Getting that historical risk off the books entirely sounds expensive.
It was. To make this happen, to transfer the liability permanently to a third party, Honeywell had to contribute $1.4 billion in cash.
Okay, $1.4 billion cash out.
Right. In accounting terms, that allowed them to remove $1.5 billion in liabilities from their balance sheet and also derecognize about $98 million in related insurance assets they held against those liabilities.
So net-net, what hit the P&L?
The net impact was booking a pre-tax loss on this expected settlement of $148 million in Q3.
Okay, so $802 million gain from Resideo, $148 million loss from the asbestos deal. Big swings.
Huge swings. And these completely distorted the tax picture for the quarter, too.
How so?
Well, the effective tax rate plummeted. It was only 16.3% in Q3 this year, compared to 22.4% in Q3 last year.
Why such a big drop?
The main reason was that the huge gain from the Resideo termination payment was considered largely a non-taxable return of basis, basically a return of capital, not operational income.
Ah, so not taxed like regular profits.
Largely, no. So that created this temporary tax benefit, even though Honeywell is actually incurring new tax costs, frictional costs, related to setting up all these separate companies for the spins.
Fascinating. And that Resideo cash, the $1.6 billion, that must have dominated the cash flow statement too.
Absolutely. If you look at cash flow from operations for the first 9 months of 2025, it was up by almost $1.4 billion compared to 2024.
And that increase was basically...
Almost entirely driven by that $1.59 billion Resideo payment hitting the bank account.
Okay, this perfectly highlights why management keeps pointing us towards the non-GAAP numbers, doesn't it? Adjusted EPS, free cash flow.
Exactly. Because measures like adjusted EPS, segment profit, and free cash flow are designed specifically to exclude these kinds of massive, one-off, non-operational items.
Right.
They strip out the amortization noise, the restructuring charges, and these huge gains and losses we just talked about. The idea is to give you, the investor, a clearer view of the actual underlying, ongoing operational performance trends.
And that free cash flow view is still looking pretty solid.
Yeah, their guidance for full year 2025 free cash flow is still in the range of $5.2 billion to $5.6 billion.
Yeah.
That shows strong cash generation from the core operations, separate from these big one-time events.
Okay, so summing it all up, they're mid-restructuring, they absorbed that big asbestos charge, they're spinning off Solstice, which you noted actually lowers their guided revenue by $700 million and hits adjusted EPS by about 21 cents. Given all that turbulence, what's the final word on the outlook for the rest of 2025?
Well, the headline is definitely confidence for management. Despite absorbing the Solstice spin impact, they actually raised their full-year guidance for adjusted EPS.
Raised it. Okay. To what?
The new range is $10.60 to $10.70 per share. If you strip out the impact of the spins and divestitures, that implies underlying growth of about 5% to 6% for the year. Pretty solid.
Okay, strong bottom line guidance. What about the top line, the sales forecast?
They fine-tuned the full-year sales guidance slightly. The new range is $40.7 billion to $40.9 billion, and they expect organic growth for the full year to land right around 6%.
6% organic for the year. So what gives them the confidence to maintain that kind of outlook while juggling all these moving parts, the spins, the restructuring?
One word: backlog. It's huge.
How huge?
As of the end of Q3, their total remaining performance obligations, basically booked orders, stood at $39.1 billion.
$39 billion. That's a lot of future revenue locked in.
It is. And they said about 55% of that massive backlog is expected to convert into revenue within the next year. The other 45% stretches out longer term.
So that provides a pretty big cushion, right? Revenue visibility for the next few years.
Exactly. It's a massive security blanket. It gives them the financial stability and confidence to execute this really complex transformation without having to panic about short-term sales fluctuations. The orders are already in the book. Hashtag outro.
Okay, so let's recap this deep dive. We've covered a massive corporate restructuring effort at Honeywell. We dissected segment performance, saw aerospace flying high, building automation looking solid, and industrial automation still finding its way.
Right, and we dug into those crucial financial footnotes, the huge one-off Resideo gain and that costly but strategic asbestos liability settlement. Those really explain the quirks in the Q3 numbers.
Absolutely. The underlying message seems to be one of focused transformation.
Definitely. They are aggressively reshaping the portfolio, zeroing in on high-growth areas like automation, underpinned by technology, focused on outcomes. They seem fully committed to these spins and realignments.
And doing it from a position of strength, given that backlog.
Precisely. That backlog provides the foundation.
So here's a final provocative thought for you to chew on as you digest all this. We know aerospace is separating. We know they're realigning the industrial side into PA&T and IA for better focus.
Right, those are the headline moves.
But think about building automation. Management keeps highlighting these huge growth drivers there, seamless building systems, unified solutions, and especially the absolutely massive global demand coming from data centers.
Yeah, data centers are a recurring theme.
So could it be that building automation, which is kind of flying under the radar compared to the big spins, might actually emerge as the new strategic centerpiece, the core engine driving Honeywell's future growth long after aerospace is gone?
That's an interesting question. Will BA become the quiet star?
Something to consider. Thanks for joining us for this deep dive.